Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Valdana Hayek, a cross-asset reporter with Bloomberg.
And this week on the show, well, let's be frank for a minute. For a long time, bonds seem to be pretty boring. If your investment portfolio was a meal, bonds were sort of like the vegetable. Yeah, you knew you needed them there on the plate, but they weren't very exciting. Rather, stocks were the meat and potatoes and dessert. Crypto, well, maybe that was the shot and beer you had afterwards. But that's all obviously changed. After last year's carnage, bonds of all stripes are sporting really attractive yields that look especially enticing these days if and when that market focus shifts from worries about inflation to worries about economic growth. And exchange-traded funds especially are reaping the windfalls with hundreds of billions of dollars flowing into bond products in the last year. You heard it, bonds are exciting again, and we're going to get into it with the head of fixed income at the world's largest asset manager. But Valdana, first, speaking of excited, I was very excited yesterday when I came into the office and I noticed you had left a book for me on my desk, which I assume means I'm finally invited to one of your book clubs, and I'm very excited about that.
Oh my gosh, I didn't mean it to look that way. But I suppose it looks that way, like I'm offering an invite.
So wait, I'm not invited to one of your many book clubs?
Okay, I suppose you and I have a book club going then, because we have a special guest next week, and you and I have been tasked with reading his book before the podcast.
Oh.
That's why I left it on your desk.
Oh.
Yeah.
Oh, that's not as exciting as one of your real
real book clubs, which you're not invited to. I'm sorry.
I'm starting to wonder about what exactly these books are you're reading in these book clubs.
They're fun.
That I'm not invited
They're fun
to.
books. No invite for you.
Tell us about the What Goes Up book club. Who do we have next week?
We have Alan Blinder next week. And
Very exciting.
He has a very thorough history of monetary and fiscal policy. So we'll be talking to him next week.
That is riveting book club material right there. But this week's guest is equally exciting. Why don't you introduce him?
Yeah, I want to bring in Steve Laipply. He's the U.S. head of fixed income ETFs at BlackRock. Steve, welcome to the show.
Thanks for having me.
You're welcome to join any of my many, many book clubs that I belong to.
I was going to say,
the
book for next week does sound riveting, so I'll have to check that out.
You're come on into our book club then. You're very welcome to be part of it.
Pour the Chardonnay.
I'll bring the cheese. Steve, maybe we can just start with, so you're U.S. head of fixed income ETFs at BlackRock. So tell us about your role.
Yeah, so I've been with the firm since 2009, and it's been quite a journey. When I joined BlackRock, bond ETFs did exist. We launched the first set of them in 2002, and we recently celebrated the 20-year anniversary of those. But it was still, a relatively nascent business in terms of where it is today. And so, we decided to really make an effort at growing that business. And in particular, I'm really trying to make the market aware of just how much these products could, number one, help investors. That's the important part. But also, we had a very strong conviction that these products were going to change the bond market itself. And so I was one of the folks brought in to really, start growing this team. And over time, we built out the bond ETF infrastructure quite a lot. And so my role currently is to oversee that business more broadly in terms of, the products that we're designing, engaging with clients on their experiences, how we can improve the products, working with broker dealers, index providers, all of the folks who are very important to the ecosystem to make sure everything functions well, just to overall make sure investors are getting the outcomes that they're expecting.
Steve, I was kind of joking at the beginning there, talking about how bonds were boring. Of course, they've always been very exciting, but clearly in that decade of zero interest rate policy or near zero interest rate policy, there's just been this massive sea change now with higher yields. Every, I think, investor strategist we spoke to recently heading into 2023 was much more bullish on bonds. That's kind of reversing a little bit now. I'm looking at some of the iShares, big fixed income ETFs, TLT, LQD, the aggregate, AGG, really off to a strong year, like the stock market, and now kind of back to maybe flattish on the year, up a little. How do you see the rest of the year shaping out? Clearly inflation and the Fed are the most important elements of how bonds will do this year. There seems to be a rethink going on about how high the Fed will actually hike and when and if inflation will actually normalize back to that 2% area. So how are you thinking that, how the rest of the year will play out in fixed income?
Yeah, it's been a bumpy ride. Last year, as you know, was the worst bond market we've seen in probably 40 years. It was incredibly challenging. I think, to your point, investors have been lulled into, a bit of, well, rates are low for long and maybe low forever. That changed very, very dramatically last year. I think investors were looking forward to this idea that, 2023, we're at these higher yields. It's great. I'm going to allocate. I'm going to fix my 40, so to speak. And then all of a sudden we got this slew of very positive data. And, that made everybody, as you said, rethink. It does feel like people rethink this and maybe overthink it every week, if not more frequently than that. I'm a little more sanguine on this. I think that, there is a limit to how high rates can go. So I think that the Fed's going to be watching the data closely. We've maintained a view that consistently that inflation was probably not going to go down in a straight line. We've been saying that for quite a while, and I think that's just what we're seeing now. There's going to be some bumps along the way. We do think that, it's possible that they may hike a little bit more than what was originally expected, and then they may hold rates at that elevated level. If you just look at the futures market, I think, the peak rate is somewhere around, and it's probably, it's bumping around, day over day, but it's somewhere, closer to a 5.5% terminal rate than it was before, but not quite there. So I think you're going to see the market, kind of trying to find a level here. And I do believe that there's a limit to this because whether people believe it or not, ultimately these hikes will impact the economy. They will take hold. There's debate about when that can happen, but it will happen. It's happened every single time in the past. So they're cognizant of that, and they don't want to, go too fast and too far.
Yeah, Steve, do you guys have an internal view in terms of what else to expect? It sounds like maybe 2 more 25 basis point hikes that we can expect from the Fed. We have had this discussion over the last couple of weeks of some Fed members arguing, even during the last meeting, that they should go with 50 basis points, that potentially the next, I think it's the March meeting, could be 50 basis points. So do you have an internal view on what we can expect?
I think we're still thinking that they probably end up somewhere, at 5.25, maybe one more. But it's really like, if you look at the market, that's pretty consistent. Unless we get, a really outsized inflation surprise. Like I said, we've been pretty consistent that it's not going to be linear. There are going to be some bumps along the way. So I think you would like to see it go down more consistently, but this isn't really surprising us all that much. So like I said, I think the market's basically pricing in, around 5.25, between 5.25, 5.5 as a terminal point.
Steve, as I mentioned at the opening, there's been some eye-popping flows into the fixed income ETF space at BlackRock, iShares, and really throughout the industry. Where are you seeing most of the flows go into? What does it sort of mean to you when you look at where the flows are going? Is it primarily the safety haven, that TLT, the Treasuries ETF, that sort of thing? Or, is there interest across the whole portfolio?
Well, it's interesting. If you would have told me last January that the largest category of inflows would have been Treasuries, I would have probably disagreed, given the how hawkish everyone was and the view that rates were going to accelerate quite a lot. But as it turns out, for us anyway, it was. We took in over 100 billion in the U.S., 125 billion globally. Of that 100 billion, 65 billion was in Treasuries, which was, again, I think most people would have been quite surprised. That was followed by investment grade, multi-sector municipals. So yes, to your point, it was all high quality. I do think that was a reflection of investors saying these yields are attractive. I can't call the top. I'm not going to try to call the top. That's pretty tough to get right. So I'm going to start allocating. But, I'm a little bit worried about where we're going here in terms of, do we tip into a recession? What do we ultimately end up doing as far as a landing goes? So I'm going to buy high quality. The part that helped that out the most, if you think about it, the front end of the yield curve, you have 2-year notes that are now above 4.5%. And so they didn't have to go down in credit to get yield. They were seeing yields they haven't seen in many years. That trend's persisted this year. We're seeing high quality flows this year as well.
To the flows into the HYG, the high yield ETF, I'm guessing they track closer with risk sentiment in the stock market. Are you not seeing them there, that they're more of a risk on type of product?
Yeah, I agree with that. And particularly HYG has become very entrenched in the high yield ecosystem. And so it does tend to react very quickly to sentiment. So when you have risk on, you see equities rally, you'll probably see flows into HYG. When you have risk off, as you said, you'll probably see the opposite. And it does happen to react quickly and in large size.
I want to ask you more about your predictions for what you see for the bond ETF space down the line. But first, you mentioned the 2-year note. It's above 4.5%. I'm wondering what you think the bond market is telling us right now, given the rise in yields that we've seen in recent days.
Yeah, I think it was this adjustment. The market had started to get to a place where, okay, the end is in sight, all is going according to plan, and we can even start thinking about a Fed pivot. It depends on what speaker, what day, but I think the last speech by Powell sort of calmed the market down, and I think got them to a place where it's like, okay, I can see the light at the end of the tunnel. This recent slew of data really upended that a bit, where you saw strong employment numbers, really outsized. The manufacturing indicators, PMI, et cetera, were strong. Inflation did not come down, as much as people had expected or hoped. And so what you're seeing, the market is just sort of pricing in, combination of, maybe an additional hike or, higher for longer, if you will. And so I think it was just that adjustment. We've seen this. So remember, I think last year, the peak was somewhere closer to 4.5. And so we've been on this journey before. We may test at some point above 4% again. But like I said, I don't think that we're going to see yields jump sharply higher. You may see them grind a little bit higher, but I think we're going to be more or less in a range. It might be a volatile one as people continue to price in and price out what the Fed may do.
Steve, you mentioned earlier that notion of bonds being that 40% of the portfolio in a traditional 60-40 portfolio. Last year was just one of those bad years where that stock and bond correlation reversed. Typically when you see stocks go up, you would expect bonds to fall, yields to go up as a result. Last year, obviously, we saw stocks and bonds fall together and sort of eliminate that, hedging aspect of a bond in a 60-40 portfolio. What do you think we need to see happen to get that correlation back to what everyone expects it to be? I mean, is it a narrative shift? Is it a sentiment shift? Or is it really about the data and inflation normalizing? I mean, do we really have to wait for 2% inflation to see that old sort of trusted correlation reemerge?
So it's a combination of some of the things you mentioned. So as long as the Fed is being very hawkish, I think that sort of perpetuates what you just said. So yields go up, you have risk off, you have equity sell-offs, high yield sell-offs, or what have you. I think when the market comes to believe that, okay, we're reaching sort of a leveling off place here, and I do think we may be starting to see that with yields bumping up closer to 4%. And like I said, I'm of the view that we will bounce around in this range anyway. But I think investors will start seeing that traditional behavior. So as an example, when you don't have a hawkish speech in the market, you do tend to see the traditional correlation where if equities are selling off, you'll see yields trend lower. I think it was really about getting to that level. I think we're almost there. And I think at these levels, there's a lot of diversification value in yields right now. So, you need to have a calming down of all the hawkish, speeches and all that stuff. But I think we're getting there.
The thing that Mike was referencing, I think, because I wrote it down, I liked what you said. You said a lot of people are thinking, I'm going to fix the 40 part of the 60-40. And I think you guys are saying that advisor 60-40 portfolios are underallocated to fixed income by 9%. So, and that now is a once in a many year opportunity to rebalance portfolios. So maybe you can tell us more about that.
Yeah, it's been interesting. So if you think about the last decade, we've had quantitative easing, we've had yields. If you look at where the 10-year bottomed out, it was 50 basis points. which is remarkable. The 2-year bottomed out somewhere in the teens, 12 or 15 basis points. So a lot of investors decided to, stay out of the market, or, they had to take on a lot of additional risk to get that yield. So whether that was overweighting high yield in that traditional part of the portfolio where maybe they would have preferred higher quality assets, but they had to have the income, or things like alternatives in private credit, private equity, asset classes of those nature. Now, investors are looking at this market, the public fixed income markets, and realizing that they can, quote unquote, fix their 40 by de-risking it to varying degrees. So you don't have to be, the majority in high yield to get a certain yield target. You can allocate to the front end of the Treasury curve and get, yields that you were seeing at some point in the high yield market. So it really is an opportunity to get back to what that 40 was supposed to do, which is diversify your risk assets. And then you think about a simple, okay, I have the S&P 500. What do I want to hold against it? A very simple, world would be, I'll hold long dated treasuries against it, Mike, for the reason you said, which was, I know that if the equity market sells off, probably long treasuries will rally. But investors are being a lot more intentional than that. They are looking at building out that 40 in a much more deliberate way. So yes, allocating building blocks to treasuries, investment grade, having some bit of high yield. And I think what we're advocating is to get away from this whole active passive paradigm, which we think is really just, kind of an archaic, construct. We think really it's both. And so we're encouraging investors to use bond ETFs for that core diversification purpose. And why is that? Well, because you know what they're going to do. You can see what the holdings are. They're transparent. You know what the strategy is because they're following an index. Use that predictability as the diversifying part of your portfolio. Okay, whether that's treasuries, investment grade, some combination of both. And then you can use an active manager to get that extra kick in your 40 as well. So it's not active versus passive, it's both. And obviously, each investor will have to decide what that mix looks like. But we do believe that both can play a role in that 40 and get you to a much more robust place than you were before.
I've never heard somebody argue that before, that it should be both.
It should be both. Yeah, absolutely. And it's a great time to do it because, like you said, it's the first time in 10 years, a dozen years that you've been able to get these yields and de-risk at the same time, which is pretty remarkable.
Steve, it's interesting when I think, and correct me if I'm wrong in how I'm thinking about this, but when I think of sort of the audience or the user base for, say, equity ETFs, I think of maybe a lot of self-directed retail investors, average Joes sort of futzing around with their retirement or just their, personal trading account. And, your big equity ETFs are pretty easy to understand for that audience. You buy the Russell 2000, buy all the small cap stocks, buy Chinese large caps, buy, whatever it is. And again, I could be wrong about this, but I don't see that cohort of investors really knowing what they're doing as well with fixed income ETFs. And my impression is that the user base is different, that it's more of a professional user based, even active bond fund managers a lot of times will park some inflows into ETFs until they can pick out the bonds they want. Talk to us about that sort of difference. Am I right in that it's kind of a different user base between the different asset classes and ETFs?
Well, actually, Mike, I think it's a pretty diversified investor base. It's pretty broad, and so we actually do see direct flows into fixed income ETFs. Now, they do tend to be the ones that people know about, like AGG. Those folks will know that, okay, that's the bond market. I'm just going to buy that. I'm not an expert. I don't want to, try to get too smart about it or, get too granular. I'll just buy the bond market. So you'll tend to see that with the direct investors. You're right that a lot of the, if you will, power users tend to be these institutional investors, active managers, insurance companies, pensions, et cetera. But then there is a very large part of the wealth client base, the advisor base that uses bond ETFs through things like models, right? So models are these recipes for here's how you build a portfolio. More and more firms are going that direction, where instead of saying, hey, buy this set of equity ETFs and then, for your bonds, just go out and, build some ladder using municipal bonds that you like, they're advocating more for, here's what your portfolio should look like. On the equity side, here's the recipe for that. It's these ETFs. On the fixed income side, you can use a combination of these ETFs. And the model portfolios are a really fast growing business, and more investors, and for that matter, advisors like it as well, because it allows them to free up their time to focus on things like, tax planning, things like that. And so we're starting to see that a lot. So that I think is the main, growth area, but we're seeing a ton of growth in the institutional side as well, to your point. And the last thing I would say about it is your traditional bond pickers, some people really love that, right? It's interesting and fun for them to do it, but even they've come to realize that if I am a bond ladder person, I can go ahead and do that for my client, but to get some diversification around that, I can buy something like, our I bonds, which is, it is a ladder, but you have within a given rung, you can have several hundred bonds. So even the folks who really enjoy laddering, as an example, are starting to use ETFs alongside of that for liquidity and diversification.
So we talked a little bit about where you see the flows going, where you said the majority is actually going towards treasuries. Is that also what you would recommend, how people should be positioning right now?
Well, I think the investors have to have a view. So for investors who are pretty unsure about whether we're going to have a recession or when that might happen, you can get great yield, right, in these higher quality exposures, whether it's the front end of the Treasury curve or investment grade or what have you. You don't have to invest in something like high yield. However, we do still have investors who are allocating a certain portion. Again, think about the model portfolios, the recipe, if you will. There's going to be an element of that, and investors can make up their minds if they think that the chance of a recession, for example, is overstated, then high yield might look attractive right now. So if you look at where default rates are implied, it's somewhere in the 6% range, which isn't super high. I mean, a lot of times during more some of these bigger sell-offs, it's approached double digits. But traditionally, the realized experience of defaults has been around sort of the high 3, low 4% range. So for investors who have that view that, well, I either think a recession isn't coming for a while, or I think it could be a lot more shallow than what people are worried about, something like high yield could also look attractive. But we're seeing people vote in terms of flows, we're seeing still the majority this year going into the higher quality segments.
You mentioned that how high rates are at that front end of the Treasury curve. I mean, every time I look at it, my eyes, I take my glasses off and wipe them off and double check that I'm really seeing a 3-month T-bill yield at 4.8, 4.9%, whatever it's.
But maybe you also need new glasses.
I might need new glasses too. I don't know. But I can't help but wonder if, we're back into the realm of extraordinary measures, to get around the debt ceiling. Is that impacting the short end yet? Concerns about the debt ceiling and a potential default? And if not, will it, how do you see that whole issue playing out this year, and what it means for fixed income?
Well, we've seen this movie before, right? Where it has happened, where we were actually downgraded and everything. But I don't. Yeah. It's not. It's there's a little bit of it that's in there. If you look at, for example, credit default swaps. I haven't looked at the levels lately, but there was sort of some of that risk being slightly priced. I think as time goes on, that concern could come forward much more. As we head towards the summer. Which is kind of a critical time. So I would say it's not dramatically impacting the front end yet. Could it? Sure. Could start creating a lot of concern as we start moving towards the summer.
And then I promised I would ask you about your long-term views. And I think you guys are predicting that bond ETF assets will go from about 1.8 trillion right now to 5 trillion by 2030. And I wanted to ask you to speak about that too.
This is something that we believe is going to happen, and I think there are a number of drivers behind that. And before last year, we also had that conviction. So I think we originally came out with a 5 trillion, even before some of the astonishing flows that we saw last year. And there are a number of trends driving that. I've mentioned a few of them already. One would be this growing institutional adoption. So we talked about how before, an active fixed income manager, as an example, would probably not touch one of these products because they viewed it as, well, that's a passive product. I'm an active manager. I'm a bond picker, et cetera. We have moved past that in our view, where you have active managers using these products just as tools for active management, which is pretty remarkable. And so 9 of the 10 largest active bond managers do use iShares fixed income ETFs, and they use them for active management tools. So that's a pretty interesting trend. And again, we're seeing insurance companies, pensions, all of these larger institutional clients really embrace the products. COVID accelerated that because of the liquidity issues you're experiencing in the underlying market. Last year was a further accelerant on that trend. Another long-term trend that we see that's been talked about a lot is just this idea of the bond market finally modernizing. Some people laugh out loud when you use the term modernize and bond market in the same sentence because it's still not what we would call that modern compared to, for example, the equity markets. But we do think that the presence of fixed income ETFs and their infrastructure has really kicked the bond market into high gear in terms of modernizing. So a lot of the things that you see today in terms of activity, call it portfolio trades, which are large bond basket trades that are priced and traded simultaneously. That's not possible without bond ETFs because they're the hedge for that. And the plumbing around that, so the creation redemption mechanism, is what brings that to life. It allows dealers to move large blocks of bonds to and from the exchange into the over-the-counter market. And so that's a very powerful innovation. I think the other part of that is just pricing. Pricing something that everyone sort of took for granted for many years. It was something that index pricing services did. Not a lot of thought was given to it, but because of this acceleration of these large block trades of bonds in conjunction with ETFs, it's become not only important but necessary to be able to price large numbers of bonds and price them quickly. So now you have things like algorithmic pricing in credit, which is pretty astonishing. I think further developments will be, all-to-all trading. You're seeing the market structure itself change, and we think all of these things were really catalyzed by bond ETFs and just the desire by investors to use these products, but also not only directly, but to use them as tools for some of the other things. We just talked about the way advisors and direct investors are using bond ETFs to build portfolios. We think that's only going to accelerate. This idea of using transparent building blocks for your 40, that's going to continue. And then lastly, we'll continue to see innovation in the number of offerings, the number and type of bond ETF offerings over time. So those are kind of the 4 long-term drivers. Like I said, we were already growing pretty rapidly, double-digit growth every single year. I think COVID accelerated that, and then the yield spike of last year further accelerated. So we're pretty confident in that $5 trillion prediction. We're approaching $2 trillion today. And honestly, if it wouldn't have been for this yield shock, which caused the values of fixed income assets to go down, we probably would have already crossed $2 trillion.
Does getting to that $5 trillion imply a shrinkage in AUM in traditional bond mutual funds?
That's up for debate. We think there will probably be a role for different types of wrappers depending on what investors like. There's certainly, you've seen a migration by certain types of investors from mutual funds to ETFs. You've seen it a lot in equities. The same thing starting to happen in the bond market, which explains why you're seeing more and more traditional active managers offering ETFs because they know that a certain segment of the investor base wants it. So I think our view is we want to give clients the exposure that they want in the wrapper that works for them. Some people don't really view the ETF as something that they need because, well, I'm not going to trade every day. I'm not going to look at it every day. It's not that big of a concern. But we talked about these model investors. They very much want ETFs as part of that. So I think over time, there will be some sort of an equilibrium, but I think we're still in the midst of a migration. What I do think will happen is that you will see more and more investors using bond ETFs instead of just going out and buying bonds, right? So as an example, if I'm an active manager, instead of going out, I want to start a new strategy. Instead of going out and buying hundreds or more of bonds to implement that strategy, I may start with a series of bond ETFs, and then I can put my higher conviction bets into individual bonds or other positions, right? So recognizing that there's always a core of a portfolio, that can easily be accomplished through a low-cost bond ETF, and then you can add value around that.
Steve, I'm going to put you on the spot with one final question here before we get to the crazy things. I'm looking at the 10-year Treasury yield now, 3.93 about. If we're to fast forward to the end of 2023 and I throw out a number, say 3.5 in the 10-year, you taking the over or the under on that? And show your math. Tell me why.
I'm going to take the over on that, but just slightly. If you were to rephrase that differently, where do you think we'll end? I would have said probably 350. So I think you'll see these bumps along the way where you just keep testing yields higher because I think people are still very nervous about the Fed and inflation, but that's all going to reconcile hopefully by December.
We'll have to call you next year and check on your prediction.
That'll be interesting. Let's hope that I'm not off by an entire handle or something.
But I agree. I don't think we'll see a collapse in yields to anything like what we were used to. But to your point, it is hard to see them going, continue this sort of march higher throughout the rest of the year. So all right, I'm with you. I'll take slightly higher too. What do you think, Valdana?
Is this the time where I admit I hate the bond market? I hate it.
Why do you hate the bond market?
Oh my gosh, because it's so counterintuitive. Like you have to flip everything in your head before you can even think about what's going on.
You like the nice, simple, easy to understand markets like crypto better.
Yes, exactly.
I was going to say, how do you reconcile that? That's even more complicated.
In my mind, it's much more straightforward. I love the crypto market.
All right. Well, Steve, it's great to hear your insights here, but we can't quite let you go just yet. We've got attrition here on this podcast. Valdana, tell them what it is.
We are going to play the craziest things you saw in the market this week.
I'll go first. For once, I'll go first. I'm gonna go first.
I was hoping to go first, actually.
Oh, all right. Well, you go first.
Well, because I have an update for something that you, I don't know, maybe it was like 5 or 6 episodes ago. I think you made me guess on an iPhone, like an original 2007 iPhone, how much it was going to go for. And the final auction took place. I don't know if you saw this.
Oh, I missed it. $30,000.
No, it's way more. It sold for $63,000.
Wow.
Yeah, it's like a vintage. I have pictures. Can we call it vintage? Yes, it's in its box with the plastic wrap and everything. Yeah, $63,000.
If that's vintage, I'm a full on antique at this point. Wow.
Yeah.
I may have one of those. May have one of those in my garage somewhere. Now you've inspired me.
Well, you have a $63,000 investment.
Go dig it out, Steve.
Put it up for auction. But I have another crazy thing. Okay, my weirdest thing is Starbucks has this new drink. Did you see this?
No. I can't believe it because my kids have make me drive them to Starbucks at least twice a week.
Well, you're gonna be driving them to get coffee with olive oil. They're literally just putting olive oil into the coffee, and I don't know how to pronounce it. It's called oleato latte with milk and olive oil.
Is that a thing? Like, is that an old Italian thing to do?
I have no idea. There's a picture, and it's like, like how they make the coffee look so beautiful, like all the milk is like dripping down. And then there's just olive oil next to all the coffees. So yeah, it looks like it's literally just olive oil and coffee. I can't wait to try it. Anyway, that's my weirdest thing.
I don't know, Steve. That's a tough one to top. What's the craziest thing you've seen in markets? I don't know how that's a market. I guess Starbucks is a
publicly traded company.
Well, all right, fine.
Yeah, I can't.
How about you, Steve?
I can't compete with that. I would say the craziest thing I've seen, and it wasn't a this week thing, but I just had this realization, when we were talking about cash in the front end of the curve, you can buy a Treasury floater, okay, which has almost no duration for I think it's somewhere between 460 and 460, 470, somewhere around there. It's amazing that you can get income off of something that has almost no duration, and it's a Treasury. So think about what you had to do 3 years ago to get that kind of yield. You either had to take on a lot of duration or a lot of credit risk, and now you can do that with Treasury floaters. That's pretty amazing.
That is a good one. When you were talking about how low yields got there for a while, I was flashing back to the whole notion of negative yielding treasuries, which the front end did, I guess, go negative for a while there. But, remember, it was this big debate if and when, would the 10-year yield actually go negative? Life comes at you fast, when you think about how that was the craziest things we were talking about a few years ago.
Very different.
It's quite a difference. But all right, I'm going to give you mine. Vildana, do you watch the WNBA at all?
No.
Women's National Basketball Association?
Just football.
Okay. Well, you might not be very good at this one then.
Is that why you chose it?
I keep an eye on women's basketball. The dirty secret in the Regan family growing up, there were 6 of us, 5 boys, 1 girl. We all, fancied ourselves as hoop stars, but my sister was really the best. She was the only one who played college ball. So I've always had
that's impressive.
A soft spot for women's basketball. Diamond Miller at University of Maryland, where my daughter goes now, is Google her highlight reel. She's something special. There is a very famous recent WNBA player, and I'm probably going to say her name wrong, but I believe it's Sabrina Ionescu. And her rookie card just sold. Her rookie card for the WNBA just sold at auction. Highest ever price for a WNBA trading card. I'll give you a few details here. It's one of just 5 copies in existence. It's graded as a perfect gem mint 10, whatever that means. That's
no
good,
clue.
I guess. That's like a AAA bond, Steve, I guess. By third-party grader PSA. So I'll take their word on it. So it's time to play the Price is Precise. as you now know. Vildana, highest ever auction sale for a WNBA trading card, according to CBS Sports, where I got this story from. What do you think it was?
I have negative knowledge about any of these topics. Literally negative.
But there's only 5 of them, so it's very unique. This is an exceptional player, her rookie card. So that's why I chose it. I think it's a challenging one.
Okay, I'm going to go with $45,000.
$45,000. I like your confidence in that answer.
It's feeling very not confident in that, but that's my guess.
All right, Steve. Price is Precise rules are the standard rules,
of that game show of a similar name.
Yeah. That shall not be named. But if you go over, you lose. So keep that in mind.
Oh, so can I do the Price is Right thing and just go over her by a penny?
Absolutely.
You can?
I'll be a little more bold. I'll say I'll do 6 figures. I'll say $100,000.
Yeah, it's a tough one. I don't know what I would have guessed, to be honest. $10,800.
Oh.
Yeah, from
Oh my
PWCC
gosh.
Marketplace.
I win.
10,000.
I won.
You won. Yep.
Right?
I don't know. You both went over, so I think.
Yeah, but I went
Both
over by
lost.
less.
And I won. I think I'm the real winner here.
Well,
as usual.
What
I
would you
won.
have guessed?
I probably would have gone closer to Steve, I think. You kind of hype it up. It depends how you hype it up. You think highest ever price, but at the end of the day, you were still talking about $11,000 for a piece of cardboard. You know, it's pretty amazing. So
I have
And
negative
60.
knowledge around card collecting as well. So
But yeah, who would have thought $63,000 for a quote unquote vintage iPhone and $11,000 for a piece of paper?
Yeah. I wonder if you can still use the iPhone.
I think so.
Or you
I'm
wouldn't
looking
want
at
to,
a
I guess.
picture
You'd
of it.
want to
It's
keep it in the
literally
box.
wrapped up. Yeah, because I guess in 10 years you'll sell it for double.
Yeah. All right, Steve, go check that garage.
yeah, I'm definitely going to check that garage.
Anyway, great to catch up with you, Steve. I hope we can have you back again someday. Maybe we'll have you back on the end of the year and see how that year-end.
Yeah.
that could be fun. I know. Thanks,
We'll do it.
thanks for having me.
Thank you, Steve.
All right, take care.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg Terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show so more listeners can find us. And you can find us on Twitter. Follow me, @Vildana Heinrich. Mike Regan is at Reganonymous. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong, and our head of podcasts is Sage Bauman. Thanks for listening, and we'll see you next week.